Mining companies raising capital difficult? Yes and no. It's a combination of where you fit on the development cycle, whether you're an exploration, an early startup company, whether you're a single asset, single commodity company, how good your management is, your geology, your quality asset, what stage are you in, are your cash flow, strong balance sheet, all of those factors come into play. As a sector, we actually haven't been covering ourselves in glory. We're currently running at probably 3, 4, 5 times consensus forward earnings in the stock market, whereas most of the stock market would be running at 15, 16 times, and the IT companies would be up there. So people are looking at us with a great deal of risk averse. A lot of investors are looking in alternative directions for growth. We've seen a shift over the last decade where the retail equity markets were doing the heavy lifting on capital for mining companies, 80%. 20% was the institutions and private equity. It's done a complete flip. But the institutions don't have the sophisticated capability to really analyse and differentiate the good assets, the quality assets and the risk management practices that go with having the confidence to invest. So if you're good, if you know your stuff, if you've got a quality asset and you can really make sure that you deliver against your feasibility studies and have the confidence, the investor has the confidence that you can, and you've got a platform of sustainable development, what they now call ESG, environment, social and governance, and you can deliver all those, you will start to instill confidence in investors. There's no shortage of capital. It's only about attracting the capital to your project. Junior explorers and startups need to concentrate on the rigour of their definitive feasibility studies. They need to build confidence in the investor that they're not going to be part of the industry where 1 in 5 projects don't deliver against their preliminary and definitive feasibility studies. Now, with a track record like that, who's going to have the confidence to invest in what is risk capital in a risk project? So there's got to be a lot of sound and rigorous analysis on what the geology actually means, what the resource to reserves conversion looks like, what capabilities and capacity you have to build the project on time, on budget, and to deliver your cash flow against your early projections. That's what they've got to be doing. Explorers are the same. They have got to build confidence. The international market looks at Australia with a bit of a skewed attitude. We have a lot of explorers in Australia, and the international investors are a bit sick of us not delivering against our promises. Investors across the globe are looking for companies that have good assets, risk management capabilities, and obviously that goes to those that are actually producing. You've got what they call cash flow lending, and that they've got really good prospects of risk-adjusted prospective returns. That's what everybody's looking for. No surprises there. You're going to say, oh, no kidding, Sherlock. Of course that's going to be attractive. But they're also looking at commodities. So you're seeing a lot of sentiment around favourable commodities, copper and base metals, precious metals, things like thermal coal and uranium. Investors are not all that attracted to that. That's more of a fad. Companies need to be thinking about countercyclical investment and attracting investors into that space. And there are more and more of the institutional managed funds and private equity who have that sophisticated capability to differentiate the quality assets, the quality commodities, the geography, where they've mitigated against sovereign risk, governments getting in the space and upsetting the apple cart. And so the opportunities are there in what we would call the counter-cyclical play. This industry, for all its acknowledgement of it being a cyclical business, doesn't actually manage the cycles very well, and getting into bed with the investors is an area where we could improve greatly. And that goes to the whole aspect of a sustainable profile, and that goes to ESG, environment, social and governance. That's the new buzz on sustainable development. But one investor said to me, I'll take a 5-bagger, that's 5-fold prospect of return, plus ESG, over a 10-bagger every day, because they're looking for that sustainable platform of growth. I keep getting invited to either speak or chair or facilitate, which is a compliment. I don't usually do speeches in Australia since I retired as the CEO of the Minerals Council of Australia at the end of 2013, mainly because I don't want to impinge upon my successors' activities. But IMARC's a little different because it gives me an opportunity when I'm asked to actually give speeches or be involved in a broader sphere of activity, just as we're discussing now. This is not a policy issue. This is more about high-level practice and high-level policies and protocols that really means that I can have a view without actually compromising the integrity of my former organisation.